ACC 325. Personal Income Taxation. Study Session 1. General Principles of Taxation. Introduction. This unit is designed to provide an insight into the general principles of taxation, which include a definition of tax and taxation, classification of taxes and objectives of taxation, etc. By the end of the unit, you should have a clear understanding of tax and taxation and the classification of taxes, as well as the objectives of taxation. Definition of tax. Tax is a compulsory levy imposed by the government, involving the transfer of resources from the private sector to the public sector for the public purpose. Tax can be imposed on income, profit, property or gifts. Meaning of taxation. Taxation is the process or system of raising revenue through the levying of different types of taxes. It is a process usually undertaken in most countries around the world. Objectives of taxation. 1. Generation of revenue for the government to enable it to fulfill its numerous and ever-growing socio-political and economic commitments and obligations. 2. Discouraging the consumption of goods and services considered to be inimical and harmful to society. 3. Stimulation of economic activities in preferred sectors of the economy to boost growth and development. 4. Checking inflation by reducing the volume of purchasing power through increased taxes. 5. Increasing the incentive to save and invest through reduced taxes. 6. Curbing excessive taste for foreign goods through the imposition of high tariffs on non-essential imported goods. Classification of taxes. Taxes can be classified into two main categories, direct taxes and indirect taxes. These are as follows. 1. Direct taxes are taxes levied on income or capital generated by factors of production. Some of the major direct taxes currently in force in Nigeria are as follows. 1. Personal income tax. 2. Companies income tax. 3. Petroleum profits tax. 4. Capital gains tax. 5. Education tax. 2. Indirect taxes are taxes levied on goods and services. The burden of the tax is usually shiftable. Some of the indirect taxes currently in force in Nigeria are as follows. 1. Stamp duties. 2. Excise duties. 3. Customs duties on imports and exports. 4. Mineral royalties. 5. Casino tax. 6. Value-added tax. Further classification of taxes. Taxes can be further classified by the distribution of the tax burden. In this regard, there are progressive taxes, proportional taxes, and regressive taxes. 1. Progressive taxes. These types of taxes take an increasing portion of the value of the tax base as it rises. 2. Proportional taxes. These types of taxes take a constant portion of the value of the tax base as it rises. 3. Regressive taxes. These types of taxes take a declining portion of the value of the tax base as it rises. Summary of Study Session 1. In this study session, please note the following. 1. Tax is a compulsory levy imposed by the government. 2. Taxation is a system or process of collecting taxes. 3. Taxes can be broadly classified into direct and indirect taxes. Taxes can also be further classified into progressive, proportional, and regressive taxes. 4. Taxation has some specific objectives. Study Session 2. Adjusted Profit Computation. Introduction. This study session is designed to give you an insight into how gains or profits from a trade or business are taxed, i.e. taxation of a sole proprietorship. Background. We shall be considering how self-employed persons are assessed to tax. When we talk about self-employed persons, we are talking about those who earn income from trade, business, profession, or vocation. The gains or profits from trade, business, profession, or vocation are assessed to tax on a preceding year basis. It must be noted, however, that for the purpose of tax assessment for an individual engaged in self-employment, it is the adjusted profit figure that is assessed to tax by the authorities. The reason is that 1. There are certain income or profits which are not taxable, such as profit on the sale of fixed assets. 2. Expenses or profits that are disallowed, such as provision for depreciation on assets because the capital allowances would be granted. Deductions. When ascertaining the income or loss of an individual for any period, it must have incurred expenses, and for any expense to be recognized it must have been incurred wholly, exclusively, necessarily, and reasonably during that period and ultimately borne by that individual in the production of the income. The deductions allowable and those not allowable are listed below. Allowable deductions. 1. A sum payable by way of interest on money borrowed and employed as capital in acquiring the income. 2. Interest on loan for developing an owner-occupier residential house. 3. Rents payable in respect of land and buildings occupied for the purpose of acquiring the income. 4. Expenses of repairs of premises, plant, machinery, or fixtures employed in acquiring the income, or for the renewal, repair, or alteration of any implement, utensil, or article so employed. 5. Bad debts incurred in any trade, business, profession or vocation, proved to have become worse during the period for which the income is being ascertained, and doubtful debts. 6. Contributions to approved pension, provident or other retirement benefits, funds under the Pension Reform Act 2004. 7. In the case of income from trade, business, profession, or vocation, any expenses or part thereon, incurred for that period wholly and exclusively for the purpose of trade, business, profession, or vocation. Non-allowable deductions. 1. Domestic or private expenses. 2. Capital withdrawn from a trade, business, profession, or vocation and any expenditure of a capital nature. 3. Any loss or expenses recoverable under an insurance or contract of indemnity. 4. Rent or cost of repairs to any premises or part of premises, not incurred for the purpose of producing the income. 5. Taxes on income or profits levied in Nigeria or elsewhere, except as provided in the Act. 6. Pension contribution not approved under the Pension Reform Act. 7. Depreciation of fixed assets. Summary of Study Session 2. In this study session, please note the following. 1. That the gains or profit from a trade, business, profession, or vocation is assessed to tax on the preceding year basis. 2. That for the purpose of tax assessment for an individual engaged in self-employment, it is the adjusted profit figure that is assessed to tax by the tax authorities. 3. That there are allowable and non-allowable expenses that must be strictly adhered to when assessing the gains or profit from a trade, business, profession, or vocation to tax. Study Session 3. Ascertainment of Assessable Income. Introduction. This study session introduces you to an aspect of the subject matter, which includes the basis period, classifying it into the preceding, actual normal, and abnormal basis periods. Basis period. The basis period defines the period to which the tax liability of the taxpayer relates. The BP provides the basis upon which the tax liability of the taxpayer will be calculated. The concept of the BP is necessitated by the need to bring into a common basis the permanent tax years of the individual or different taxpayers who are not constrained by law to maintain a common tax year. Preceding year basis period, PYBP. The PYBP precedes the fiscal year of the government. In other words, the correct PYBP will have ended before the commencement of the government fiscal or tax year. The government fiscal year begins on January 1st and ends on December 31st. Therefore, any year end that comes before the fiscal year of government is the PYBP. Actual year basis period, AYBP. The AYBP coincides with the fiscal year of government, which runs from January 1st to December 31st of every year. For the tax year of 2013, the AYBP of a business owner is 1st of January 2013, to the 31st of December 2013. Normal basis period, NBP. The NBP is described to have the following features. 1. The period involved in NBP is neither less than nor more than 12 months. 2. There must be continuity in the NBP in the sense that, the next basis period must commence immediately after the end of the last basis period. There must be only one permanent year-end. NBP is relevant for businesses in continuous operations, not for taxpayers. Abnormal basis period, ABBP. The ABBP occurs in the absence of the features examined in PYBP, AYBP, and in the NBP. Put more clearly, ABBP occurs in the following circumstances. 1. On commencement of a new business. 2. Where there is a change in accounting date. 3. On the cessation of a business. The commencement rule. The commencement rule applies where a new business commences operations. The basis period for assessable profit is determined based on the following rules. Year 1. The basis period commences from the date of commencement of business up to the end of the government tax year, which is December 31st of the same year. Year 2. The basis period commences from the date of commencement of business up to the end of the first 12 months. This represents the accounts of the first 12 months or 1 year. Year 3. The basis period will be on preceding year basis. It is to be noted that the Year 3 rule is not sacrosanct, and therefore may not hold. In other words, it may be difficult to obtain a corrective period. Where this occurs, the second year, basis period together with the associated assessable profit should be repeated in the third year. The change in accounting date. Taxpayers may decide to change their financial or accounting year ends. Where this occurs, it is the responsibility of the relevant tax authority to determine the basis upon which tax liability will be computed. The following steps usually occur when a taxpayer changes its accounting date. Step 1. Identify the year when the business changing its accounting date first failed to prepare accounts to the old year end. This represents the first tax year under the change in date. Step 2. Determine the 2 subsequent tax years. Step 3. Determine the basis period for assessable profit and the corresponding assessable profit on the preceding year basis using the old year end for the 3 years identified in steps 1 and 2 above. Step 4. Determine the basis period for assessable profit and the corresponding assessable profit on the actual year basis using the new year end for the 3 years. Step 5. Compare the sums of assessable profits in steps 3 and 4 above. The basis upon which the relevant tax authority will assess the taxpayer shall be on the higher of the assessable profits obtained in steps 3 and 4. The significance of the change in accounting date is that it is the relevant tax authority that determines the basis of assessment and not the taxpayer. The cessation rule. The cessation rule applies to a business that ceases. When a business ceases operations or folds up, there is the need to provide for the determination of the basis period to which the assessable profit will relate. The cessation rules apply to the last 2 years. These are the penultimate year and the ultimate year. 1. The penultimate year. The penultimate year is the year before the year of cessation of business or operation. The basis period for the assessable profit is on the preceding year basis. 2. The ultimate year. The ultimate year is the year of cessation of business or operations. The basis period for the assessable profit is on the actual year basis. Summary of Study Session 3. In this study session, please note the following. 1. The concept of the BP is necessitated by the need to bring into a common basis the permanent tax years different taxpayers who are not constrained by law to maintain a common tax year. 2. 4 basis periods include the preceding year basis, the actual basis period, normal basis, and abnormal basis period. 3. Abnormal basis period results in rules of commencement of a new business, change in accounting date, and the cessation of a business. Study Session 4. Capital Allowances. Introduction. In this unit, we discuss capital allowances provided for by the Personal Income Tax Act, PITA, 2004 as amended. It focuses on its meaning, basis for granting capital allowance, categories of qualifying capital expenditure, and the rates applicable. Meaning of capital allowance. Capital allowance is a form of tax relief granted to a taxpayer who has incurred qualifying capital expenditure on depreciable assets used for the purpose of a trade or business. PITA specifically disallows depreciation and expenditure of a capital nature for tax purposes. Conditions for granting capital allowances. Certain conditions must exist to qualify the taxpayer to claim capital allowances. These include: 1. The business must have incurred qualifying capital expenditure as defined by the first schedule of PITA 2004 as amended. 3. The asset for which the claim is being made must be used for the purpose of the trade, business, profession, or vocation. 4. The relevant tax authorities must be satisfied with the terms of the lease agreement. 5. The lessor must have agreed to forego capital allowance on the asset in question. 6. Qualifying capital expenditure in respect of such asset must be incurred. 7. The asset must be in use at the end of the basis period. 8. The minimum value of capital expenditure that qualifies for the capital allowance, with effect from 1995, is 500,000 naira. Categories of qualifying capital expenditure. Different categories of capital expenditure that qualify for capital expenditure exist. These categories are as listed below. 1. Buildings. 2. Industrial buildings. 3. Mining. 4. Plant and machinery. 5. Furniture and fittings. 6. Public transportation. 7. Housing estate. 8. Agricultural plant. 9. Research and development. 10. Ranching and plantation, and 11. Construction plant and manufacturing industrial plant. Bases for granting capital allowance. Profits from a trade or business and capital allowances are granted on the same basis, i.e. the accounting period before the year of assessment for which the claim is made. However, for commencement, cessation, and change in the accounting date of a business, overlapping or coinciding periods and gaps or intervals do occur when granting capital allowance. These are discussed below. Overlapping or coinciding of basis periods. When two basis periods overlap or coincide, the period common to them shall be taken to belong to the earlier basis period. This will often occur under the commencement of a business. Gaps or intervals between basis periods. When there is a gap or interval between two basis periods, the question of which basis period such a transaction is deemed to belong would arise. Usually, a gap will occur between two basis periods either under the cessation of a business or when there is a change in accounting date. The general rule is that where there is a gap or interval between the end of the basis period for 1 year of assessment and that for another year of assessment, the gap, for capital allowance purposes, shall be deemed to be part of the second year of assessment period, except if the second year of assessment is the year of cessation of a business, in which case the gap shall be deemed to be part of the first year of assessment, which is the year preceding the year of cessation. Types of capital allowance. The types of capital allowances available are discussed below. 1. Initial allowance. This allowance is claimed in respect of qualifying expenditure incurred in the basis period in which the asset was first used for the purpose of a trade or business and is granted once in the life of an asset. 2. Annual allowance. The annual allowance is granted on a straight-line basis throughout the tax useful life of the asset. It is granted in the basis periods in which the asset was used. Unlike the initial allowance, the annual allowance computed must be prorated to reflect the number of months in the basis period for computing profits. 3. Investment allowance. This allowance is usually granted in order to encourage investment in some preferred sectors of the economy. An investment allowance of 10% is granted to businesses in respect of capital expenditure on plant and equipment used for agricultural production and on new production machinery used for manufacturing. 4. Rural investment allowance. This is an investment allowance introduced in 1993, in addition to an initial allowance, for businesses that have incurred capital expenditure on the provision of facilities such as electricity, water, tarred road or telephone for the purpose of a trade or business which is located at least 20 kilometers away from such facilities provided by the government. It can however not be claimed on the same asset on which an investment allowance has been claimed. 5. Balancing charge. Where on the disposal of a fixed asset its realizable value exceeds the tax written down value, a balancing charge would occur. A balancing charge is an additional taxable income, which is added to the assessable income. 6. Balancing allowance. This occurs where on the disposal of qualifying capital expenditure the realizable value of the asset is less than its tax was written down. Balancing charge is an additional annual allowance deductible from the assessable income, thus reducing the tax liability. Meaning of disposed of. We shall consider this with respect to buildings, plant, machinery, and fixtures, and qualifying mining expenditure. 1. Building. A building, structure, or works of a permanent nature is said to be disposed of in the occurrence of any of the following events. 1. The relevant interest is sold. 2. If the interest was used in the business on the basis of a concession when the concession comes to an end. 3. If the building, structure, or works of a permanent nature was acquired under a lease agreement, the return of the asset is returned to the owner. 4. The interest is demolished or ceases to be used for the purpose of the trade or business. 2. Plant, machinery, or fixtures. These are said to be disposed of if they are sold, discarded, or cease to be used for the purpose of the trade or business, or if insurance, or compensation monies are received thereof. 3. Qualifying mining expenditure. These are said to be disposed of if they are sold or if they cease to be used for the trade or business, or if insurance, or compensation monies are received thereof. Summary of Study Session 4. In this study session, please note the following. 1. Capital allowances are granted in lieu of depreciation, which is specifically disallowed for tax purposes. 2. The meaning of capital allowances. 3. Categories, scope, and rates of capital allowances. 4. Conditions for granting capital allowances. 5. Basis periods for granting capital allowances and the various complications arising from there. 6. Meaning of disposed of and the value of an asset at the date of disposal. 7. Computation of capital allowances for personal income tax purposes. 8. The meaning and scope of capital allowances and how they are computed for tax purposes. 9. That businesses should endeavor to take advantage of this special tax relief by making a claim to the relevant tax authority whenever a qualifying expenditure is incurred by them, as this will reduce their chargeable profits and consequently, their tax liability. Study Session 5. Capital Gain Tax. Introduction. In this unit, we carefully examine capital gain tax and its computations. The Capital Gains Tax Act of 1967 provides for the computation of capital gains tax at 20% up to the end of the 1995 tax year and 10% from 1996 to date. Capital gain tax. This is a tax arising from the disposal of a chargeable asset. It is 10% of the capital gain from the transaction, and it is usually expressed on an actual year basis. However, when there arises a capital loss on disposal of any asset, is not deductible from capital gains on disposal of any other asset, even if both are of the same type. Chargeable assets. These are assets upon which capital gain can be charged, and they are basically charged on the capital gain arising from the disposal of the asset. Allowable and disallowable expenditure. For the purpose of capital gain, the below expenditure would be treated as allowable. 1. Any selling expenses such as advertisement. 2. Any professional fee such as legal fee, accountant fee, estate value fee, agent commission. 3. Any refurbishment cost or any cost of improving the asset prior to sale. 4. Any cost of acquisition of the asset concerned. Gains exempted from capital gains tax. A. Capital gains arising from the disposal of federal government security. B. Gains accruing to local government councils. C. Gains accruing to any diplomatic body. D. Gains on the disposal of the main or wholly private residence of an individual. E. Gains on the disposal of land to an authority with compulsory powers of acquisition. F. Gains accruing on the disposal of investment held as part of any superannuation fund. Artificial and connected person transaction. In taxation, certain people are treated as being closely involved with each other to the extent that transaction between them is seen as the same person transaction or transaction not done at arm's length. Such transaction will be referred to as connected person transaction or artificial or fictitious transaction. Examples of connected person transactions are transactions between 1. A man and his wife, vice versa. 2. A man and his in-law and vice versa. 3. Two separate companies own the same person. 4. Two separate companies controlled individually by a man, his wife. 5. Two partners within the same partnership. Partial disposal. This occurs where part of a whole chargeable asset is the disposal of. It may be difficult to correctly determine the cost of the part disposed of. However, to resolve this, the following relationship should be used in determining the cost of the part disposed. Cost of part disposed equals A divided by A plus B equals C, where A equals sales proceeds on part disposed, B equals market value of the unsold part, C equals original cost of acquiring the whole asset. Capital gain tax computation. In computing this tax, the below are some of the steps involved. 1. Determine the sales proceed from the disposal of the chargeable asset. 2. Deduct all incidental selling expressed to arrive at the net sales proceed. 3. Deduct the cost of acquisition to arrive at the capital gain. 4. Determine the capital gain tax liability by subjecting the capital gain to a tax rate of 10% obtained in Step 3 above. Summary of Study Session 5. In this study session, please note the following. 1. The basis of capital gain tax. 2. The difference between capital gain and chargeable asset. 3. Identify connected person transaction. 4. How to determine the cost of part disposal. 5. How to compute capital gain tax. Study Session 6. Taxation of partnership business. Introduction. There are various forms of business such as sole proprietorship, joint venture, partnership, and limited liability company, and the taxation of these forms of business differs. For example, the income or profit of a sole proprietorship is the income of the owner and therefore is taxable in the hands of the owner of such business. What is a partnership? A partnership is the coming together of two or more persons for the purpose of business. Normally, profit maximization is the main objective of any business, and in partnership, this profit is shared in the agreed profit or loss sharing ratio as contained in the Deed of Partnership or Partnership Act. Income of partnership and partners. The income of the partnership depends on the nature of the business. For example, a partnership firm carrying on accounting/auditing services for clients earns fees as income, while an estate management firm or legal practitioner firm also earn various forms of professional fees. Relevant tax authority. The principle of residence, whereby the place of residence of the taxpayer becomes the relevant tax authority, applies in partnership. However, if the residence of the partners is different from the location of the partnership business, the relevant tax authority of the location of the partnership business suffice. Summary of Study Session 6. In this study session, please note the following. 1. Partnership remains a viable form of business in Nigeria and many other countries. 2. The profit of the partnership business is shared among the partners in their agreed profit or loss sharing ratio, which ultimately becomes the income of the individual partners, and such income is taxed in their hands. 3. Partnership business does not pay tax, but the partners do, and it is computed based on the prevailing personal income tax rate.